Hi, welcome to this podcast. I'm going to look briefly at the start of a IAS 7 cash flow, which is a legal requirement for companies to show in their accounts. Okay, just briefly, I'll do another video on how we use a cash flow, but the cash flow statement is basically split down into four key sections. You've got the top half, which basically looks at the profit the business has made and then actually works out how much cash it's made from doing its operations. You've got the middle chunk, if you like, the middle bit, which looks at cash flows from investing activities. So what a business has spent from buying non-current assets and any proceeds, any money it's received from selling them. You've got the profit, the cash flow from the financing activities. So that's things like taking out new long-term loans, selling shares, redeeming shares, paying back loans. And at the very, very bottom, there is the change in the actual cash in the business. And what you should find at the bottom section, if you look at the net increase in cash and cash equivalents of 109,000, that should equate to the difference between the cash and cash equivalents at the start of the year and at the end of the year. So if we look at this example, they started the year with 326,000 cash and cash equivalents. By cash equivalents, we mean things like the bank account. And the end of the year with a 435,000. And if we add 109,000 onto that, then 326,000 plus 109,000 equals 435,000. And therefore we have proof that we've accounted for all the cash inflows and outflows of the business. Okay, which profit do we use? We use a profit called operating profit, which is the profit before finance charges and tax have been deducted. Just be a little bit careful. I'll do a quick example of why you need to be careful. They don't always give you the operating profit in the questions. Sometimes you'll need to work back to calculate what the operating profit is. So be very careful, for example, if you only get the actual profit for the year, because you need to add back the tax that's being put in as an expense, and you need to add back any finance charges. Okay, so we have a quick look at an example of where we haven't been given the operating profit. In this example here, we've got a change in retained earnings, dividend paid, tax and finance costs. So the first thing I'd need to do here is, this would come from the statement of change in equity. And the main things that happen in retained earnings is obviously you've got the opening balance, you normally add on any profit, subtract any dividends, and potentially you might have a transfer out of the general reserve. And then that would give you your closing retained earnings. So we kind of need to work our way backwards through that. So the first thing is there's been an increase of retained earnings of 50,000. So if there'd been no dividends paid and no transfers to other reserves, then we would say that was the profit for the year. But in this case, we've got some dividends that have been paid, so we need to increase that by 50,000. And that says that the profit that we've put into the statement of change of equity would have been 100,000. Okay, we then need to add the tax, because don't forget, we're working our way back to the operating profit. So we're working our way backwards through what you'd normally see at the bottom of the income statement. Okay, so we need to add the tax on, and we need to add finance costs on, and that gives us a real operating profit of £250,000. Okay, we're going to now, so we've got to this point here where we've got the cash flow from the operating activities, and we now need to adjust this amount for the non-cash expenses. What do we mean by non-cash expenses? We mean things like provisions, where although we put depreciation in as an expense in the accounts, and it's right to do so, that isn't a cash outflow. Cash outflow occurred when we bought the non-current assets some time ago. And Therefore, what we need to do, we need to add back provisions to the operating profit, because although we deducted 20,000 in the expenses from the revenue, that 20,000 wasn't cash leaving the business. So therefore, we add all provisions on, and it doesn't matter what provision it is, if it's bad debts, unrealized profits, or for depreciation, all provisions would get added back. With the possible exception of bad debts or provision for unrealized profits if there's been a decrease in the provision. Just be a little bit careful when you're looking at the depreciation on the non-current assets. Sometimes they will give you the cumulative depreciation at the end of 2 years. And if you do that, if there's been no disposals, then the difference between the depreciation, accumulated depreciation at the start of the year and the end of the year will equal the expense. But if you've got any disposals, you'll need to think about it and probably do I would recommend doing a depreciation account with opening, closing balances and the amount into the disposal. And that way you can calculate the actual depreciation expense in the income statement for the year. But you'll see that as you work through some questions. Okay, and the one that's slightly trickier is profit or loss on disposal, because a loss on disposal goes in as an expense, and that would go in as a non-cash expense because the actual cash flow is linked to the investing activities. The money that we receive would go in as an inflow in the investing activities. So if we've made a loss on disposal, we would treat that like depreciation and we would add it on to the operating profit. Obviously, it's possible and quite a frequent occurrence to make a profit on disposal. Profits on disposal are non-cash income, and that would actually need to be deducted from the cash, from the operating profit, because we add that on in the income statement, and yet it's not been a real cash flow. And at the end of it, and don't forget your titles in this as well, there's quite often a mark for getting some of the titles right. After we've adjusted the operating profit for the non-cash expenses and incomes, we get the operating profit before working capital changes.